please welcome Professor David R. Beatty from the Rotman School of Management, University of Toronto.
Thank you. Assalamu alaikum. Your Excellencies, ladies and gentlemen, at lunch I'm going to talk to you about global competitiveness in the kingdom with respect to public equity markets. And this is no normal marketplace. This is very congested and hotly competed in. There's some 63,000 publicly traded companies, 63,000, over some 170 stock exchanges in over 100 nations. So this is a very difficult competitive setting, and one in which you need a differentiated strategy to survive. I'm going to talk about the supply side, who's in these markets and what they do, about the demand side, who buys these stocks and how they think, and finally an example of one country that may have got a reasonably good start on competing to win. On the supply side then first, this is an index from 1900 to 2012 of the world stock markets. And you'll see clearly the dominance of the United States in this marketplace. The United Kingdom and Japan are stacked above it, and you'll see the Japanese market has contracted somewhat. The US market is very different from many other markets, and I'd just like to share a few of those anomalies with you. You know that in the land of the free and the home of the brave, the way it ought to work is the shareholders elect the board of directors. The board selects the management of the company, the CEO, and the CEO then fills in the managerial ranks. And at the annual general meeting, when the board is elected, the shareholder also elects the auditor, whose purpose and job is to study the affairs of the company financially and report back to the shareholders. That's the way it's supposed to work. But how many of you knew that, in fact, in the United States and in Canada, the only two jurisdictions in the world, the shareholders don't elect the board? Is that news? What in fact happens is something called plurality voting. Plurality voting is a voting system where instead of voting for and against, as you might expect, you vote for or withhold. And all you need is one person to vote for you, and you are elected. So as long as your mother or grandmother is a shareholder of the company you wish to stand for as a director, you just need her to vote for you, and you are on the board. Plurality voting, Canada and the United States. Now, this is a system of election that was founded by that great, well-known entrepreneur and champion of democracy, Vladimir Ilyich Lenin, who said, vote for the slate or don't vote because it doesn't really matter anyhow. And that is the system of governance we have adopted in the North American continent, quite different from anybody else's. Now, you may remember 2002, we had a whole bunch of criminal activity occur in the US and in the European markets. Companies like WorldCom, Adelphia, Enron, HealthSouth, the list goes on. There were a number of them. Fortune felt it should call it system failure, and The Economist said American capitalism takes a beating. Anybody remember these guys, Kenneth Lay and Jeffrey Skilling? Household names back in the North American continent. Mr. Skilling convicted on 1 count of conspiracy, 12 counts of securities fraud, 5 false statements, and 10 insider trading. He was convicted to 185 years in prison, and Mr. Lay to 165. Unfortunately, Mr. Lay passed away before he could serve any time, but Mr. Skilling is still in jail and has had his sentence reduced to 24 years. WorldCom, Bernie Ebbers. This collapse was enormous, so much so that a special commission was put in place, run by Richard Breeden, to inquire into the nature of that collapse. And he reported, and this is a public document, he reported the board consistently ceded power to him. As CEO, Ebers was allowed nearly imperial reign over the affairs of the company without the board exercising any apparent restraint, even though he did not appear to possess the experience or training to be remotely qualified for his position. Remotely qualified. Quite extraordinary. The company went bankrupt, and at the time, it was the first largest bankruptcy in history, and today actually it's number 3 after Washington Mutual and a little-known company called Lehman Brothers, which went under with $680 billion in debt, eclipsing the record set by Mr. Evers. But he won't be coming back because he's in jail for the rest of his life. I do point out to American audiences, however, that he was born in Canada, my home, and that we export our best and our brightest to the United States. Now, it's up to you, Miller. The only thing that can save us now is an accounting breakthrough. And for those of you in the crowd of that profession, my apologies, but there is a company that typifies false accounting, and that's Health South. Health South specialized in the manufacturing of earnings. 11 former Health South executives, including all 5 men who held the CFO position, have pleaded guilty to criminal charges, and all 5 accountants have pleaded guilty but were given probation. Oddly enough, the CEO and chairman of this company, Richard Scrushy, got off without a sentence of any nature, nor did he pay any compensation in recompense. But this was a company created solely for the purpose of manufacturing earnings. This resulted in Sarbanes-Oxley, the Act of 2002. Sarbanes-Oxley Act sought to get around this problem of plurality voting in a number of ways. Firstly, it reestablished an independent audit function so that the auditor really did report to the board and hence back to the shareholders. Secondly, it made the directors independent of management. The United States has a peculiar problem of a combined chair CEO in about 65% of their publicly traded corporations. So the objective here was to ensure that there were enough directors on the board of directors that they could act independently of management. And then thirdly, it made the CFO and the CEO sign off on the finances at the risk of criminal charges should they be egregiously shown to be out of whack with reality later. So this was Sarbanes-Oxley. They also took away the right of the auditors to act independently of an oversight agency, and this is the Public Accountability Oversight Board led by the reputable chairman, William McDonough, formerly a president of the Reserve Bank. It's called peekaboo, and peekaboo now requires that you go in front of it as an auditor before you are allowed to audit the books of any company. In addition to which, they set up all kinds of auditing standards. The conclusion was drawn by one senior audit partner that management used to own the auditor-client relationship, no longer. And in addition to that general statement and to the need of the audit companies to get approval to audit any company's books, there's all kinds of rules about the need for expertise on audit committees, the inability of people who are on the audit team to work within the company they audit for a number of years, and so on. So a dramatic change in the relationships between the board of directors, the auditors, and the operating company and the shareholders. Some of you might have been shareholders in a large international bank in 2007, and you may also be aware that a short 2 years later, those capitalizations had dramatically shrunk. Citibank, which used to be out on top with a market capitalization of $255 billion, if we abstract from the Chinese banks, the largest is HSBC with a market cap of $55 billion. Now, Citigroup went from $255 billion to $19, the diminution in shareholder value. It's difficult to see the green dot up there, and I think that's how you would have felt if you'd owned those shares before the market crashed. If any of you are involved in risk management, you'll be interested in this quote from the Financial Times. Citi claimed that their risk management system worked perfectly, but unfortunately it was based on incorrect assumptions. Very comforting for the shareholders to know that they had a perfectly working risk management system. In total, these 15 banks had a market capitalization write-down of $1.7 trillion. $1.7 trillion. Never, including the Great South Seas bubble, has a society been so shaken by a collapse of the stock market as in the collapse of our global banking system. This has been an extraordinary, extraordinary event. And so now the whole financial world is engulfed in regulatory reform. In the United States alone, started by Treasury Secretary Mr. Geithner, followed on by the Governor of the Board Federal Reserve, Mr. Bernanke, and including the Controller of the Currency, the FDIC, the Securities and Exchange Commission, the Capitol, and the White House. All these agencies in the United States alone, and a plethora of them in Europe, seeking to redress the challenges that were apparent in the global financial system. That's ended up in the Dodd-Frank Act, which is interesting, as in 2010 it set a world record for acts of major financial legislation. You'll see it's at 2,319 pages, and I think it was just getting started. That could be the table of contents. Went to 2,319 pages, whereas the Federal Reserve Act itself was only 31 pages long. And now we have the Volcker Rule, trying to limit the amount of independent trading on their own books that major financial institutions can accomplish. This is from J.P. Morgan, as that firm seeks to understand how these various offices in the United States are going to oversee all of their various businesses. And if that doesn't look like a spaghetti chart, I don't know what does. It is going to be enormously expensive for the global financial industry to match and meet all the requirements of these various legislative reforms. And that's just in the United States, not including Basel III and a number of other regulatory reforms around the world. The economist's view was it's too big not to fail, which kind of is a twist on Bob Posen's book from Harvard, Too Big to Fail, which he wrote about the banking crisis. And he had a rather simple prescription, actually, Mr. Posen. He said, boards of banks should be smaller, harder working, and more expert. Instead of that, we have this Dodd-Frank Act, which is going to strangle a lot of enterprise, in my view. So, after a catastrophe, things need straightening out. We got rid of the crooks and their ability to manipulate the books, we think, with the Sarbanes-Oxley reforms. We're now working on fixing the banks with the Dodd-Frank reforms and the Paul Volcker rules. Has anybody out here ever had a computer crash? Any hands up, computer crashes? Only that many? Nobody at the front's ever had a computer crash? I've had a few myself, okay. Well, how about this for a computer failure? This is UBS. UBS wanted to buy 8,000 shares of Facebook when it got listed. It sent the order in and got back a, sorry, couldn't fill your order. So guess what its computer continued to do? Its computer continued to send the order, and it continued to get rejected. So eventually they bought 800,000 shares 32 times. When they discovered that, they decided they'd better sell. They sold at a loss of $8 to $9 a share and took a loss of $356 million in 1 hour, trying to buy Facebook up against a computer failure on the NASDAQ exchange. So how far do you think we would trust computers to manage the world's global markets, let alone our own Amazon.com orders? High degree of trust? Let's take a look at another part. This is the flash crash of May the 6th, 2010. The market declined 9.2% in about 10 minutes. Some of the stocks that went down that day, look at the one on the bottom, Accenture. Now, if you'd have been a small shareholder of Accenture trying to sell 100 shares that you saved up for a long time and wanted to go on your holiday, and you decided that you would pay for it by selling your 100 shares of Accenture, there is a moment in time when you would have got a penny for a stock that a moment in time earlier had been worth $40 a share. These are real quotes from a real marketplace in real time. Knight is what they call a high-frequency trader. You can see the banks of computer screens, and that's only part of their enterprise. They had a $440 million loss, called now the nightmare on Wall Street. This is a chart in milliseconds. A millisecond is 1/1000th of a second, showing the number of trades in 1 second of data in millisecond slices. Unfortunately, their computer programmer, you can't see the dots very well, but at the top, they bought at the top, and then they immediately sold at the bottom. And this was a pretty severe glitch in the computer system. They were buying upside down. In total, though, they lost 15 cents on every trade, times 2,400 trades per minute, times the 30 minutes it took to find out there was a problem, which equals $440 million gone in half an hour. That's not bad, right? Wiping out $500 million worth of market capitalization in a half hour's worth of trading just because of a rogue computer algorithm. This is typical, in fact, of our marketplaces now. It takes 350 milliseconds to blink. One blink, 350. A hummingbird's wings take 20 milliseconds to flap. On Friday, June the 7th of last year, ISM Marketing, and that's the Institute of Supply Management Data, was inadvertently sent out by Thomson Reuters to a bunch of high-frequency traders 15 milliseconds before it went to the market at large. 15 milliseconds, less than the time it takes a hummingbird to flap its wings once. And in that 15 milliseconds, front-running the market, they made $28 million. Now, if they did that every millisecond, that'd be 2 million, which would mean $2 billion a second they would have earned by their front running of the market due to that time differential. This is extraordinary stuff. It's stuff we've never seen before. High frequency trading. Here's a landline between Chicago and New York. We started off with 14.5 milliseconds for a round trip. The next generation went to 13.1, the next 9.0, the next 8.5, and now a series of microwave towers allow the transmission of an order to go to Chicago and come back to New York in 4.5 milliseconds. The speed of light is 3.9. So this stuff is being transmitted at the speed of light. There's now coexistence of high-frequency traders on the same building, one floor above, of the securities regulators marketplace. 4.5 milliseconds for a round trip to Chicago. And this isn't rare. In the United States, it's now estimated that 85% of all trades on all of their markets are done by high-frequency traders. And look through the list of other things: futures, options, foreign exchange, fixed income. And this is not just the United States. The dark lines there are Europe, and you've seen a growth from 2007 with about 10% up to 45% of the volume on their markets today, and in Asia up to 20% of their volumes today. And that's only going to go in one direction, and that's up. And there are a lot of exchanges. In the United States, there are 12 for-profit exchanges, and there are another 30 dark pools. These are not called lit markets because they have only preferential access to members who wish to trade stocks amongst themselves. So that's 42 different places a share could be traded in the US markets. You add that to high-frequency trading. Here's a company called Spansion, which in 30 minutes of trading by milliseconds, traded 25,000 shares. Every time you see a little blue dot up there, that's a trade. Now, the average size of that trade is about 200 shares. So these are tiny, tiny slices, but these are milliseconds. 30 minutes of trading, 25,000 shares in units of about 200 a share. Almost all of this by high-frequency traders trying to outgun and outguess each other. But clearly an impact on the retail market. 90% of all the orders in the US marketplace are in the market for less than 1 minute. If you don't think that's a challenge, 50% of the orders in the US marketplaces are in the market for less than 1 second. Less than a second. And 20% of the orders are in the market for less than 10 milliseconds. We've never seen anything like this before. Every exchange in North America and Europe is now debating the pluses and minuses of high-frequency trading, whether it adds liquidity to the market or whether, precisely when you need the liquidity in the market, it's gone. Unbelievable. So we have to ask further questions. We fixed the banks, we got rid of the crooks. Are high-frequency traders good or bad? And are dark pools good or bad? Lastly, in the U.S., second lastly, we have activist shareholders. Up here I've put Mr. Ackman from Pershing Square and Mr. Econ from Econ Capital. In 2012, there were 241 activist campaigns targeting a change in the company's strategy or a change in the board, up from 187. So another feature of North American and some European markets are the adventures of activist shareholders. There's a number of areas they attack, but on the field of corporate governance, here are some of the companies they did attack. You'll recognize the names, J.P. Morgan in there, Chesapeake, Oxy. Huge numbers of attacks on companies that are not performing in terms of corporate governance or in terms of return to shareholders. Are activists good or bad? We can add to the list of the American market challenges. And finally, this is Mark Weisman, who runs the Canadian CPP, the Canadian Pension Plan Investment Board. It's about $250 billion, going to over $400 billion when fully funded. He's teamed up with Dominic Barton, who will be here tomorrow from McKinsey, and they're leading a campaign to get rid of short-termism in marketplace. Now, what's your definition of short-term when you come to corporate strategy? On a scale of 1 to 10 years, if you'd all put your hands up, I'm going to ask you to bring your hands down as we go out the years from 1 to 2 to 3 as to what you deem to be the appropriate time frame which you as an owner or a CEO or as a director of a company or as a shareholder of a company would deem to be the appropriate time frame in which your company would think about its strategy. So if everybody sticks their hand up at 1 year, we all agree it's got to be 1. Somebody else participate. What about, anybody take it down at 2 years? You would. 2 years, okay. Anybody still there at 3, 4, 5? We've lost everybody at 5. All right. Oh, there's a 6 over here. 6. Do I hear 7, 7, 7? Do I hear 8, 8, 8, 9? Going for 9. 9, 9 once, 9, 9 twice. Going for 10. All right. The McKinsey survey, 2013, 1,000 board members and C-suite executives from around the world. They all agreed that it had to be greater than 3, which I think is a pretty modest accomplishment. I think your consensus might be closer to 5, and that would certainly be my instinct. 79% of them said actually their corporate strategy was being developed with a time horizon of less than 2 years. And over 30% said, in effect, they were running their companies year to year, kind of the quarterly earnings forecast. Miss the quarterly earnings forecast, you get murdered in the share market. We then said, what's the pressure like in the last 5 years? 63% of those 1,000 people polled said the short-term pressure had increased in the last 5 years. And yet, 86% said longer time frame for strategy would equal better results. So there are huge pressures in North American and in some European stock markets to get the next quarter right, which is at the very real cost of the longer-term survival of the company. And Dominic will probably speak about this tomorrow. So those are all the things that are anomalies in the American marketplace. How to reverse short-termism being the bottom. And that's the United States, the largest stock market. Now, we'll turn now to some of the others. In the United States of America, which we just discussed, if you had 100 poker chips and you were asked to allocate them in one of 2 piles, 100 chips, one of 2 piles, in the United States, a large company that's publicly traded exists for the interests of the shareholders, or a large publicly traded company exists for the interests of other stakeholders. If you were given 100 poker chips, just think for a minute, how many would you allocate to shareholders and how many would you allocate to stakeholders? Anybody brave enough to shout out an answer? In the US? Yes, sir. Oh, that's a waiter, sorry. Anybody brave enough to hazard a guess? 80-20. Does that sound good over there? 80-20? What would you have said over there at that table? Right there. 80-20? Okay, pretty close to the answer. Now, who was the brave gentleman who suggested that? I'm going to put you on your medal. If we went across the Atlantic Ocean to the United Kingdom and did a similar poll, do you think that green line would be getting bigger or smaller? Smaller. By a little or a lot? 64-65. Do I hear 50-50? No? Okay, the answer is 71. Almost the same, right across the Atlantic Ocean. If we did the same survey in France, just go across the English Channel, what do you think would happen? Green line getting bigger again or going to get smaller? Smaller. A little or a lot? Professor? A lot. Over on this side, I've left you pretty much untouched. We're moving across the English Channel, 100 poker chips to be allocated. Is that green line going to be smaller or bigger than the line in the UK? Any volunteers? Bigger. Bigger or littler? Okay, the answer is 22. Dramatically different. If we go to Germany, my number one interlocutor, go to Germany, how would that look? About the same? No. It's going to go back up again. Wrong. And what about Japan? You give 100 poker chips to a bunch of Japanese people, 3,000 Japanese with considerable education, and you ask them the same question: is the interest of a publicly traded company in Japan to look after the shareholders or to look after all the other stakeholders? What's the interest going to be for shareholders? Any volunteers? 2. He's right ahead. Isn't that extraordinary? Almost don't exist. The purpose of a publicly traded corporation in Japanese society is to look after the life employment of its members. So you'll see there's huge differentiation in the way people think about the purpose of a public company in their jurisdiction. In Europe, there's 1- and 2-tier boards. They're boards with and without co-determination. Co-determination is the right of the unions or the laborers to be represented on that board. And then there are other variants underneath, so that when you finally apportion countries to the kind of board structure they have, you see huge diversity. So as nations seek to give structure to the way in which they oversight and manage their publicly traded companies, they do so in dramatically different ways. In Germany, for example, half the members of the 22-member supervisory board, half the members have to be union representatives by law. It's not discretionary, it's by law. Now that means that things are very different than anything in North America, and yet Germany works. Germany appears to work very well, not only due to its small and medium-sized enterprises, but also to its large publicly traded corporations. That kind of a structure would find no place, no home whatsoever in North America or in the other parts of Europe. But it works well in Germany. If we look at another characteristic of boards of directors, the number of the directors who are insiders versus those who are independent and outside. See, in Japan, they're basically all insiders, and as we go to the UK and the US, we find the number of green for independent rising dramatically. In Japan, for example, of the 1,668 Tokyo-listed companies, 1,091 have no independent directors. Now in North America, following Sarbanes-Oxley, we think that's a very bad thing. But in Japan, it appears to work very well. Which publicly traded company would you rather have owned, Canon or Kodak? Canon has 32 directors on its board, 32, all of them current or former employees of Canon. Kodak, besides its CEO, has 12 American CEOs, hard-driving, unremitting, never leaving a stone unturned, demanding answers. Which companies survived, which prospered, which would you have rather owned? I think the answer is pretty clear. In this case, Canon. Toyota versus GM. It works fine in Japan. It's absolutely not the way things work on North American boards. So boards, their structures, their processes, their policies, and the very purpose of a publicly traded companies change dramatically as you change jurisdiction. So there's still a lot of publicly traded companies out there. On the demand side, who's buying these companies? Well, in the US, in 1950, only 6% of shares were owned by institutions. In 2005, it peaked at 68%. Today, that number is about 70%. So of the top 5,000 companies traded in the United States Stock Exchange, 70% are owned by institutional investors, large, sophisticated funds. Does corporate governance matter to these people? Yes, it matters a lot. In a recent ISS survey, you'll see the blues there. Japan, probably least, 52%. But you take a look at Canada, they said corporate governance matters a lot in Canada, 84% to our investment decision making. Huge impact of the way in which the board is managed, worked, and run on the behavior and predilections and investment decisions of the institutions. In the United States, there is no one single oversight institution. We have CalPERS, CalSTRS, the Association of Public State and County Executives, and TIIA-CREF, but no single unifying body. In Europe, on the other hand, Eumedion was formed 5 years ago to represent 45 different pension funds with some 800 billion in assets. In the Far East, the Asian Corporate Governance Association monitors the Far Eastern markets. And in Australia, the Australian Council of Super Investors. So these large pension funds, these large financial institutions, have agglomerated together in order to influence the behavior of publicly traded companies. For example, in the Far East, the Asian Corporate Governance Association actually marks annually the scores of 11 different stock markets, rates them against the benchmarks, which they take to be the American markets, the UK, and Australia, and gives a qualitative assessment along with some very detailed information, not only on the market itself, but on individual companies within it. Across the Atlantic, we have the ECGI, the European Corporate Governance Institute. We also have the global networks, the ICGN, and at my business school, we have the International Center for Pension Fund Management. We've run 4 courses for them, and the average amount of assets represented in those courses is $10 trillion. Institutions pay a lot of detailed attention to the way in which companies are run in publicly traded markets. ISS has a global business advising these funds for profit on governance regimes and their ratings. And their views can unseat boards of directors very quickly. Glass Lewis is another company in the same business, and Moody's and Standard & Poor's now both include governance ratings in their assessments of corporate debt. So this is a widely watched field. The World Federation of Exchanges has 60 member companies running 100 stock exchanges, plus 40 affiliates and 30 who are not members, scattered around the world. So if you seek to enter into the business of competing with these other stock markets, you're entering a business that has a great deal of complexity, diversity. Corporate governance codes written by the ECGI are 11. The Global Corporate Governance Forum, an offshoot of the World Bank, works around the globe writing corporate governance codes. They now have 60 of them. And there's 11 different specific codes that relate to specific industries like banking. So there's a huge amount of activity trying to measure, think about corporate governance and to set standards for it. So differentiation in such a market is tough. 170 stock markets, 70 codes, institutions owning the companies up to 70%, very sophisticated institutions, and many oversight bodies who are measuring, commenting on, and sometimes operating for profit to advise the institutions on where and where not to invest their money. So these are the largest stock exchanges in the world, led by the NYSE Euronext, which is about 12 trillion in sales, And Tadawul sits somewhere between Singapore, Mexico, and the Bursa, Malaysia in terms of total market capitalization. But there are a lot of existing exchanges out there that you can see on this list, and there's a lot more you don't. So how do we compete to win? In the Canadian setting, we put together something called the Canadian Coalition of Good Governance, which started with the pension funds, added the banks, and then all the other money managers. We ended up with 50 members and assets under management of $1.2 trillion. We had a three-pronged strategy. The first was Peter Drucker. I had the honor to serve as vice chairman of Peter Drucker's foundation for a number of years. And Peter said the way to get a wagon train moving more rapidly across the plains was to go to the front of the wagon train and find out what they did so well, and then bring it back to the middle. Forget the ones on the end, they'll be taken care of anyhow. The Drucker strategy, you go to the front, you find the best practices, and you bring the best practices back to the middle. Secondly, and these are some of the best practices books. Every year, the Canadian Coalition, which I founded and ran for 5 years, puts out a book of governance disclosures called Best Practices, which is at the front of the wagon train. And inside that, for every single category, we list the specific companies and their specific best practice and the people who did it, and provide that to everybody in the Canadian marketplace so they can all share in the best practices. Second strategy we adopted was Justice Brandeis. He was a celebrated justice of the U.S. Supreme Court, and his insight was that sunlight provides the best disinfectant. So what he did was say, shine a light on something and the bad things run away. We set up in the Clarkson Center a series of measuring governance in Canadian publicly traded corporations, and every year now, that is published in our national newspaper, the Globe and Mail. The whole business section that day is completely devoted to corporate governance as it is practiced in Canada. And inside the paper, there is a detailed ranking of 273 publicly traded companies. So that everybody on every board of every publicly traded company in Canada is fully well aware of how they are doing versus best in class and how they are doing versus their previous years. This is our 12th year. And the last thing we did as our third part of our strategy was to work with those who had a similar interest, whether they were the stock exchange, the investor relations people, the CFA Institute, which is a great colleague, Canadian Society for Corporate Secretaries, and we palled up with everybody who had the same aspirations as we did to make corporate governance in Canada the best in the world. I'm happy to tell you that a study done by the ECGI a few years back in 2007 did proclaim that Canada was the best corporately governed nation on earth. And that's after having looked at the corporate governance practices of almost 8,000 companies in 23 countries using the ISS metrics. So whether we're a kinder, gentler country than our neighbors to the south or not, I don't know. But we certainly are very pleased to know that Canada, as a destination for investable funds, spent on investment by large publicly traded companies, by pension funds, is a very amenable marketplace to go. Now, as we think about Saudi and entering into this market, the kingdom, it has many, many well-respected institutions already in place. Not only the Capital Markets Authority, the market itself, the Monetary Agency, and SAGIA, but also the Board Directors Institute, Al Faisal University, and the media. So there's a lot of preconditions that are well established here in the kingdom. And the kingdom's market capitalization, although it's still only internal, is $400 billion, vastly exceeding that of any other local market area. And it has a carefully crafted evolution that began almost 30 years ago with the formation of a ministerial committee to regulate and develop the market. So the preconditions are certainly here in the kingdom to choose their path forward. And as they do so, as you do so here, I think you should clearly fashion these institutions and publicly traded companies, if you do open up your markets, in a way that befits your society, your culture, and your views, because there are many different ways to be public, as we've seen in many different countries. And I wish you the very best as you go about that. Shukran jazileen. Shukran jazilan. Thank you. I've been asked to tell you that when you finish your meal, you will be reconvening in the salon just over to your left. Thanks again.